Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Big money goes to capital, not labor. In 1985, IBM had nearly 400,000 employees. Today, NVIDIA is nearly 20 times as valuable and 5 times as profitable as IBM was back then. Adjusted for inflation, and it employs roughly a tenth as many people. That one comparison is the whole story. It's not a tech story. It's an incentive story. It's a capital allocation story. It's a story about who gets paid in the modern economy and who doesn't. This is the Wall Street Journal's Capital Account column, written by Greg Ip, and it's doing something that serious investors should do more often. It's taking a single clean comparison and using it like a flashlight to illuminate the structure of the entire system. The claim is simple. The rewards of the economy are going disproportionately toward capital instead of labor. Profits have soared since the pandemic, and the market value attached to those profits has soared even more. So capital businesses, shareholders, and superstar employees wins. The average worker ekes out marginal gains, and that divergence helps explain something that feels confusing if you only watch the headline numbers. Why the economy can look buoyant while households feel pessimistic. Both can be true, because if the upside is going to asset owners, the economy improves in the aggregate, but most people's day-to-day doesn't change very much. Now, let's talk like operators. Who is the central figure in the story? It's not NVIDIA, it's not IBM, it's not any CEO. The central figure is capital itself, how it is defined, how it is deployed, and how it is compensated. And the most important phrase in the piece is value added. A manufacturer's value added is sales minus inputs like parts and raw materials, and that value added gets distributed to labor, wages, and benefits, or to capital profits and interest. Some is depreciation, replacing worn-out or obsolete assets. That is the accounting skeleton. Everything else hangs off that skeleton. Now the inflection point. This isn't new. The shift to capital from labor has been underway for more than 40 years. In 1980, labor received 58% of the proceeds of economic output, as measured by gross domestic income. By the third quarter of last year, that fell to 51.4%. Profits share rose from 7% to 11.7%. This is not a one-quarter phenomenon. This is a multi-decade drift. And the journal tells you why the drift happened. In the 1980s and 1990s, unions declined, outsourcing spread, and workers' bargaining power got weaker. Then the nature of capital changed. Less spending on long-lived factories and buildings, more spending on computer equipment, software, and intellectual property that must be replaced every few years. And then automation. First in manufacturing. Machines, robots, computers replacing workers. Pasquale Restrepo, a Yale economist, says that in 1980, 66% of value added in factories went to labor. By the 2000s, that was down to 45%. That improved productivity and gave consumers cheaper products, but it also meant displaced workers often took lower-paid work elsewhere. Restrepo and Darren Acemoglu estimated this can explain about half the drop in labor share of output between 1987 and 2016. So this is a repeating pattern. Technology increases productivity. Productivity lowers costs. Costs lower prices. Prices raise living standards for consumers. But the wages tied to the displaced jobs don't automatically reappear at the same level. Now, the pandemic offered a brief inversion. The journal says the COVID-19 pandemic briefly put workers on top, employers bidding up wages amid a labor shortage. But prices rose almost as much as wages. Profits, after an initial hit, romped to new highs. So even the moment of labor power didn't persist. Now we get to the core of the article's modern thesis. Tech business models differ fundamentally from earlier eras. The capital isn't factories. It's algorithms, operating systems, standards, self-reinforcing user networks. And NVIDIA designs but doesn't manufacture its products. So the company that captures the most value doesn't need to capture the most headcount. That's the mechanism. Now, you asked for visuals to be recreated in words, with explicit cues, so here it is. On screen, the viewer sees a table titled Real Market Capitalization and Number of Employees for the Largest Companies on First Trading Day of Select Years. It's a timeline of who the market crowned as most valuable and how many people those giants employed. IBM, in 1985, roughly $0.2 trillion market cap, about 400,000 employees. Exxon in 1990, about $0.2 trillion, about 100,000 employees. GE in 1995, about $0.4 trillion, about 220,000 employees. Microsoft in 2000, about $1.5 trillion, about 40,000 employees. GE again in 2005, about $0.8 trillion, about 310,000 employees. ExxonMobil in 2010, about $0.6 trillion, about 80,000 employees. Apple in 2015, about $1.2 trillion, about 100,000 employees. Then the modern cluster in 2026, Alphabet about $3.5 trillion, with about 180,000 employees. Apple about $3.8 trillion, with about 160,000. Microsoft about $4.2 trillion, with about 220,000. And Nvidia about $4.5 trillion, with about 30,000 employees. The viewer can see the regime shift visually. Market cap explodes. Employee counts do not scale the same way. The economy's biggest winners are no longer its biggest employers. Then on screen, the viewer sees a set of ratios that function like an X-ray. Corporate profits as a percentage of gross domestic income, rising from about 7% in 1980 to about 11.7% in 2024. Labor compensation, falling from about 60% to about 51.4%. Household stockholdings as a percentage of disposable personal income, rising from about 50% in 1980 to almost 300% in 2025. S&P 500 profit margin, rising from about 5% in 2010 to about 13% in 2025. This is the compounding machine. Drawn out. Profits higher. Margins higher. Stock wealth larger relative to income. So the economy becomes more sensitive to market fluctuations because wealth starts to rival wages as a driver of consumption for the households that own most of the stocks. The Journal drives that home with a vivid estimate from Doug Pita of BCA Research. A 10% stock return, including dividends, taxed at the highest marginal rate, boosts spending capacity as much as an 18% rise in income. So if you're wondering why tepid job growth doesn't stop the economy, that's one mechanism. Now, the reality check. Declining labor share gets framed sometimes as businesses underpaying workers, but the Journal argues it's more about a shift in the sorts of businesses dominating the economy. Superstar companies pay well but don't have many workers. Alphabet's revenue grew 43% over 3 years, while headcount stayed flat. Amazon is a big employer because of fulfillment centers, but even it is eliminating jobs. And then there's the blur between capital and labor. Stock compensation. Human capital gets paid like capital. Acquihires exist to buy talent. Meta paying $14 billion for a stake in Scale AI to nab founder Alexander Wang is cited as an example. Now, bring this to the inflection point going forward. AI. The Journal warns AI could funnel even more output toward capital. And it quotes Dario Amodei of Anthropic. AI isn't a substitute for specific jobs, but a general labor substitute for humans. That could create a world where large enterprises are disrupted and replaced with much less labor-intensive startups. Markets tasted that last week when Anthropic unveiled tools for tasks like writing legal briefs and synthesizing data, hurting specialized software stocks. Restrepo predicts that as companies integrate AI, a shrinking share of revenue will go toward labor-like factories in decades past. And white-collar workers could see the same wage pressure blue-collar workers faced earlier. There will be winners. Jobs requiring social skills, proximity, manual labor. Consumers getting cheaper products and services. But the biggest winners, the Journal says, will be shareholders. Now, lessons. 3 of them, timeless and brutal. Lesson 1. In a capital-led economy, ownership is the main lever. Wages can rise, but when profits and multiples rise faster, asset owners pull away. Lesson 2. Technology doesn't just create new products, it changes bargaining power. When the production function needs less labor, labor's slice shrinks unless institutions counterbalance it. Lesson 3. AI is not just another productivity tool. It's a general-purpose substitute that can compress entire layers of labor, which means the compounding may show up more in margins and valuations than in payrolls. And I'll end with one sentence that should stick in your head for years, because it tells you how to think about the next decade as an investor. In the AI economy, The scarce resource isn't labor hours, it's capital ownership. Moving to next title, migrant raids hit Texas economy. Half-built homes sit empty. Not because demand disappeared, not because the land isn't there, they sit empty because workers are gone. This is the Wall Street Journal in South Texas, in a place called Monte Cielo, a new housing development in West Laco. And the quiet is the point. A few workers hover behind temporary wrap tacked to wall frames, and the development feels like someone pulled the plug on the system. Builders say federal immigration agents have hit the development repeatedly, at least half a dozen raids in recent months. The most recent raid, they say, was a few weeks ago. 8 workers were arrested in what the builders describe as chaos. Laborers running away, federal vehicles racing through a 3-street subdivision at high speed. And that one operational fact, workers being taken off the job midstream, creates a chain reaction that looks to an investor exactly like a supply shock. Homes are months behind schedule, contractors can't recruit replacements, and the people who might take the job hear the name Monte Cielo and say no. Alejandro Garcia, one of several builders working there, says it plainly. You can pay me whatever you want. I'm not going to go work there. That's labor supply turning into labor refusal. Not on wages. On fear. And fear is not something you can bid away easily. Now, I want to treat this story like a case study in incentives and constraints, because housing is a simple business in theory. You buy land, you build, you recycle capital. But the compounding depends on one thing being true. The production line must keep moving. And in construction, labor isn't a footnote. Labor is the production line. The journal says the situation is becoming familiar across the Rio Grande Valley. Trade groups are raising alarms that aggressive immigration enforcement is wreaking economic havoc. Construction delays threaten higher prices for buyers and lower margins for builders. Some builders say they just hope to break even. Materials suppliers are laying off employees. And one local concrete company filed for bankruptcy protection, citing a drop-off in sales. That's the thing most people miss about local economies. Their networks. A job site isn't just a job site. It's a demand node for concrete, lumber, title services, inspections, transportation, food, tools, trucks, fuel. When the job site slows, the whole network feels it. Now, who are the central figures? First, ICE. U.S. Immigration and Customs Enforcement. Whether or not you agree with the mission, in this story it functions as the binding constraint. It shows up, it removes labor, it changes risk perception, and it changes behavior. Second, the builders, operators who allocate capital into projects under assumptions about time, labor availability, and completion. Third, the trade associations, the institutional voice trying to protect the continuity of the labor pipeline. And fourth, local officials trying to balance political incentives with economic reality. The journal quotes Mario Guerrero, chief executive of the South Texas Builders Association. He says, they are basically taking everyone in there working, whether they have proper documentation or not. Then he adds a line that exposes the political tension inside the region. He voted for President Trump, along with most of the region. He supports deportations of criminals. But, he says, when you are terrorizing job sites, people are afraid to go to work. That's the conflict in one sentence. 2 priorities, curbing illegal immigration and strengthening the economy, can collide in the real world. And South Texas is a heightened example. Now zoom out. The journal says contractors across the country are seeing similar pressure, where ICE activity has intensified. Home builders in Minnesota relayed raids that picked up whole work crews, even those with legal documentation, according to Grace Kelleher, Executive Vice President of the Builders Association of Minnesota. Nationally, a third of commercial contractors reported being affected by immigration enforcement in the past 6 months, according to a January report by the Associated General Contractors of America. So this isn't isolated. This is a pattern. Now look at the regional setup. Hidalgo County is growing at twice the rate of the U.S. overall, according to census data, up to 915,000 people in 2025. Growth means household formation. Household formation means housing demand. Housing demand means construction. And McAllen Mayor Javier Villalobos says he worries raids will raise home prices and dampen new business investment. He says it affects everybody. They're still doing well, he says, but they know what happens if it continues. That's a mayor speaking like an operator. A region can absorb shocks for a while, but persistent shocks change investment decisions. Now the labor math. In 2024, immigrants, with and without legal status, accounted for more than half of construction trade workers in Texas, California, New Jersey, and the District of Columbia, according to Riordan Frost at Harvard's Joint Center for Housing Studies. Builders say the share is higher in the Rio Grande Valley, so the industry's labor input is not marginal, it is central. And then the journal reports something that changes how you model the risk. Builders say the raids are not only netting immigrants in the country illegally, but also those with legal authorization. 2 guards at a nearby immigration detention center say they frequently see detainees arrive still wearing dusty work clothes from job sites. They say a significant portion of the men they guard have valid work permits, and those detainees still wait weeks to see a judge before being released. Think about what that means operationally. Even if you are legally authorized to work, you can still be pulled off the line and disappear into a multi-week queue. So the job site doesn't just lose unauthorized labor, it loses labor period. And once that happens, fear becomes generalized. People become afraid to work whether they have legal authorization or not. That's when labor supply collapses faster than anyone expects. Now, the economic evidence. Paul Rodriguez, CEO of Valleyland Title, estimates residential construction activity fell 30% in recent months in Hidalgo County. Then we get a second, harder data point from the materials layer. 57 Concrete, a large regional concrete supplier, saw concrete use fall 60% between late May and November, says CEO Eliud Cavazos. 60%. That's not a mild slowdown. That's a cliff. The company had to lay off 60 of its 150 workers. It shut a continuous improvement department. It halted new investment. And the 5-year-old company filed for Chapter 11 bankruptcy reorganization. In December, Cavazos says the filing is the most responsible thing I can do. And here's the detail that makes the story feel real. His employees, U.S. citizens or with legal work status, would frequently witness immigration raids while delivering products. Sometimes builders were left with half-poured foundations that they would have to pay to rip out and redo because laborers were arrested mid-job. If you've ever poured concrete, you know why that matters. Concrete is time. You don't pause concrete. You either complete the pour or you destroy it and start over. So the raid isn't just labor removal. It's direct rework cost. It's waste. It's margin destruction. It's the opposite of compounding. Now, the visuals. On screen, the viewer sees photos from the journal. They see months behind schedule homes in West Laco, frames exposed, empty lots, a sense of stalled motion. Then they see Eliud Cavazos, and the caption tells them his company, 57 Concrete, had to lay off over a third of its workforce. The images are evidence. They're telling you the same thing the numbers are telling you. The production engine is stalling. Now, what do trade groups do when the production engine stalls? They escalate. The journal says trade groups held emergency meetings with hundreds of members, leaned on local lawmakers, and Guerrero and others flew to Washington for meetings to try to reduce enforcement activity on construction job sites. This is lobbying as a survival instinct, not for subsidies, for predictability, because businesses can plan around almost anything except random interruption. Now, the reality check. This story is uncomfortable because it forces a basic question. What happens when the labor input that underwrites your regional growth becomes too risky to show up? And the answer is, prices rise, timelines slip, investment slows, and the second-order effects hit suppliers and service businesses. The journal is showing you that the housing crisis isn't just about mortgage rates and zoning. Sometimes it's about whether the production line can legally and practically keep moving. Now, lessons. Lesson 1. Labor is a hidden balance sheet item. You don't book it as an asset, but your entire project schedule is implicitly financed by it. Lesson 2. Policy shocks don't hit evenly. They hit where your supply chain is concentrated. In the Rio Grande Valley, construction labor concentration is the vulnerability. Lesson 3. Compounding requires stability. If you want builders to recycle capital into the next project, you need completion, cash conversion, and confidence. When fear interrupts the line, capital stops compounding and starts defending itself. And I'll end with the one sentence I want you to remember, because it is the essence of the journal's reporting here. When enforcement turns job sites into risk zones, housing stops being a supply problem and becomes a throughput problem. Moving to next title, China sets high bar for locals. There is a phrase in this article that should make any serious investor sit up straight. Internal dumping. It's the idea that a foreign manufacturer moves production into the United States and then uses low prices to undercut American manufacturers from inside the country. Not by shipping imports across a border, by building the plant on your side of the border. And then winning anyway. This is the Wall Street Journal describing what rivals and China hawks in Washington say is happening in the U.S. auto glass industry. And once you understand that concept, you realize it's bigger than auto glass. Because the question underneath it is simple. What does it even mean to be local in a world where capital, labor, subsidies, and supply chains can be assembled like Lego bricks? Now, the central figure in the narrative is a Chinese glassmaker, Fuyao, and the counterparty, the incumbent that feels the pressure, is Vitro, based in Monterrey, Mexico, operating plants in the U.S., including one in Crestline, Ohio. You can already see the complexity. This is not American versus foreign in a clean way. It's a fight over who gets to occupy the American industrial base, and under what rules. The journal says Chinese companies like Fuyao trounce competitors with a combination of production efficiencies and, allegedly, illegal labor practices as well as subsidies from Beijing, at least according to their critics in Washington. Fuyao's success has set off national security concerns in Congress and some federal agencies. The fear is that China could disrupt the American automotive sector and other crucial industries if it gains significant market share at the expense of factories operating in the U.S. Nasdaq Composite, a former Commerce Department official in President Trump's first term, says the Chinese government is systematically weakening the U.S. economy from within its own borders. The Chinese embassy in Washington rejects that claim. So right away you have two narratives fighting for control. Narrative 1, efficiency and scale. Narrative 2, subsidies and rule breaking. And as investors, we have to do something uncomfortable. Hold both possibilities in mind until the evidence becomes clearer, because capital markets punish people who pick a story too early. Now, here's the operational reality on the ground. Vitro's leaders say they've done everything possible to wring efficiencies out of their decades-old plant, installing new equipment, reducing the number of employees. But they still can't match Fuyao's prices. Rich Perrin, plant manager at Vitro in Crestline, says their volume has dropped 50% in the last 7 years. 50% volume loss is not competitive pressure. Fuyao declined to provide pricing. But a person familiar with the matter says Fuyao prices generally run about 10% less than competitors. 10% is the kind of gap that changes buyer behavior. It's the kind of gap that over time changes the fate of a plant. Now, the article puts a human face on the manufacturing economics. Chandra Jarvis has worked 13 years at the Vitro plant in Crestline, a distressed rural town of about 4,500 residents, roughly a 2.5-hour drive from Fuyao's factory. Union wages help the 48-year-old single mother support her daughter through nursing school and her son through high school. That's not sentimental color. That's the why behind political pressure. Plants aren't just profit centers, they're community balance sheets. And when volume drops 50%, the community is leveraged to that outcome whether it wants to be or not. Now, let's talk about the inflection point. The inflection point is not just that a Chinese company is competing in the US, it's that Chinese firms are coming in under a strategic logic that confuses the old defenses. Tariffs are designed to make imports more expensive. But if you build the plant inside the US, you are now domestic in a physical sense. So the old policy tools don't map cleanly onto the new strategy. That's why there's talk in the Trump administration, according to people familiar with the matter, about how to regulate Chinese firms located in the U.S. The journal says similar complaints are erupting in other industries too. U.S. Dash-based copper companies are worried they'll be undercut by Chinese firms building and operating new processing facilities in the U.S. So this is spreading across industrial categories. And the White House spokesman Kush Desai tries to hold the middle. The administration wants more investment into American manufacturing without compromising national and economic security or immigration and antitrust laws. That line tells you something vital. They're trying to optimize multiple constraints at once, and systems optimized for multiple constraints tend to produce conflict. Now, here comes the political volatility that makes long-term compounding hard. The journal says President Trump has said he welcomes new investment in the U.S. by Chinese companies, even in the automotive sector, that he has used tariffs to protect. He's quoted saying, "If they want to come in, build a plant, hire you and your friends and neighbors, that's great. Let China come in." At the same time, people familiar with the matter say the president could derail new restrictions if the U.S. strikes an investment deal with Beijing, and Trump is expected to meet with Xi Jinping in April. So, as an operator trying to allocate capital into an American factory, what do you do with that? You can't model it like a stable rulebook. You have to model it like a shifting negotiation, and that increases the discount rate on long-lived investment. Now we get to the legal and enforcement layer, the decision autopsy for how this became a national story. Vitro's concerns reached Washington after federal authorities conducted a raid on the Fuyao plant in 2004. The U.S. alleges that Chinese business owners formed a web of dozens of commercial enterprises in Ohio to facilitate the harboring, transportation, and employment of illegal aliens at various factories, including Fuyao. And Fuyao allegedly funneled $126 million to companies in the scheme, according to a civil forfeiture complaint filed in U.S. District Court. No one has been charged. Fuyao denies wrongdoing. And Fuyao's spokeswoman, Stella Zhang, attributes success to production prowess and economies of scale. Fuyao says its Moraine plant employs more than 3,000 workers, most from the area, and is expanding. Zhang says long-term success can't be achieved by price alone. She says customers choose Fuyao based on technology, product quality, delivery reliability, and service. And she says all Fuyao employees were authorized to work in the U.S. and that the investigation targeted suppliers, not Fuyao itself. Now, there's another layer in the details that matters for how you think about risk. The complaint says some employees told law enforcement they were trafficked across the U.S.-Mexico border. But it also says nearly all Fuyao employees had documentation showing they were legally permitted to work in the U.S. Government records show the company received 33 H-1B visas in fiscal year 2025 for its Ohio facilities, about 1% of its local workforce. Many employees from Fuyao suppliers named in the investigation didn't show up for work on the day of the raid, the complaint alleges, and none of those absentees had legal permission to work in the U.S. So the story is messy. It's not a clean villain narrative, it's a supply chain labor and compliance narrative, exactly the kind that creates uncertainty, and uncertainty is what kills investment. Now, the on-screen visuals. On screen, the viewer sees a set of photos credited to Maddie McGarvey. They see a Vitro worker, Chandra Jarvis, at the Ohio plant. They see Jennifer Utt inspecting glass at the Vitro plant in Crestline. They see the Fuyao factory in Moraine, Ohio. They see Fuyao employees working on an auto glass production line. This matters because it makes the core point undeniable. These are real American jobs on both sides of the competition. This is not a hypothetical trade debate. It's a fight between two production systems operating on U.S. soil. Now, let's talk incentives the way a value investor does. Fuyao's incentive is scale, unit cost leadership, and winning contracts with automakers like GM, Ford, and Stellantis, which the journal says Fuyao supplies in the U.S. Vitro's incentive is survival. Keep a decades-old plant competitive long enough to justify reinvestment, and keep the payroll alive. Washington's incentive is conflicted. Attract manufacturing investment, protect critical supply chains, avoid being gamed, and manage political promises about jobs and sovereignty. And labor's incentive, workers, are caught between macro narratives and the micro-reality of the paycheck. Now, the reality check. No one has been charged in the case tied to the forfeiture complaint. That means the information environment is unresolved. And unresolved environments create three things: rumors, resentment, and policy overreaction. You can hear the resentment in the workers. Kim Sumner, a 25-year employee at Vitro, asks if you wouldn't resent your job being threatened. Jarvis asks, "They say they want to make America great again. Where's our help?" And you can see the policy appetite too. Sen. Bernie Moreno wants Fuyao under new ownership. Sen. John Husted says he's concerned about trafficking allegations. Rep. Hal Rogers inserted language in a government funding bill directing the Justice Department to detail efforts to combat alleged human trafficking in the auto glass industry, involving any company with ties to the Chinese Communist Party. Politics is now inside the competitive landscape. So what are the lessons? Lesson 1. In manufacturing, a 10% price gap can be a moat if it's durable, and a weapon if it's subsidized. Either way, the outcome looks the same to the incumbent. Volume disappears. Lesson 2. Once national security enters the chat, the business stops being only about ROIC and starts being about permissions. Permission is a moat, but it's also a variable that can change. Lesson 3. Long-term compounding in industrial America requires stable rules. If the rules shift based on negotiations, enforcement actions, or headlines, the country gets less reinvestment, not more. And I'll end with a sentence I want you to remember because it captures the uncomfortable core of the journal's story. When your competitor builds inside your borders, the battle moves from tariffs to rules, and rules are where politics decides who compounds. Moving to next title, Goldman led way to Dow 50,000. The Dow just hit 50,000. And the most important thing about that milestone is this. Most people don't know what they're actually looking at. They think they're watching the market. They think it's a scoreboard for the American economy. They think it's a clean summary of value. But the article I'm holding in my mind, out of the Wall Street Journal, makes a different point, quietly, almost politely. The Dow is not a neutral mirror. It's a machine with rules. And those rules decide which companies matter, which companies don't, and how your perception gets shaped over time. So when the Dow crosses 50,000, the right response isn't celebration. The right response is inspection. Because when you're a value investor, you don't clap for a number. You ask what produced the number. What are the incentives behind it? What are the hidden weights? What is compounding here? And what is just optics? Now let's start with the cleanest fact in the piece. The Dow Jones Industrial Average topped 50,000 for the first time on Friday. And in a tech-dominated market, some surprising stocks powered the climb. Surprising only if you don't understand the index design. Unlike the other major U.S. indexes, where big tech has been the engine, industrials and financial companies tend to have greater importance in moving the Dow. Why? Because the Dow isn't weighted by market capitalization the way the S&P 500 is. It's weighted by share price. That is the entire story. And it's also the part that most people skip. The journal reminds you how the Dow is calculated. You add up the prices of the index's 30 stocks. Then you divide by a factor that accounts for things like stock splits and new entrants. That's it. So companies with a higher share price have a bigger impact on the index's moves, regardless of their market value. Read that again and tell me it doesn't change the way you interpret headlines. Share price, not market value. So if you're a company with a very high-priced stock, you're effectively louder inside the Dow. You're heavier. You push the number around more. And that makes Goldman Sachs, the article says, with shares around $929 apiece at the end of Friday, the biggest driver. Now, this is where I want to switch into the founders and allocators lens, because there isn't one CEO driving the Dow. The central figure here is the index methodology itself. The index design is the allocator. It decides what gets rewarded with attention. It decides what gets blamed when the number moves down. It decides what gets credited when the number moves up. And if you're an investor who cares about signal, you have to understand your measurement tools the way you understand accounting. Because if you don't understand the tool will fool you. Now let's talk about time. It took just over 8 years for the Dow to climb from 25,000 to 50,000. That's after a more than century-long journey to hit the 25,000 milestone back in 2018. This is the seduction of compounding. At first, it's slow. Then it looks like it's accelerating. But the fact that it took 8 years to double is not a pure economic truth. It's partly a function of which companies were in the index, which companies had high-priced shares, and how those shares moved. Now we get to the evidence. What the viewer sees on screen. On screen, the viewer sees a bar chart titled Point Contributions to the Dow's Run from 25K to 50K. And the key detail is that it's broken into two parts. Current constituents, plus 26,200 points. Former constituents, minus 1,158 points. That right there is a quiet lesson about turnover and narrative. The Dow is not static. It evolves. Companies come in, companies leave. And the contribution math applies only to the period when each constituent was part of the index. So even the history is conditional. The chart lists a pile of names, some expected, some not, and what they contributed. And then, like a good operator who knows you need to name the drivers, the journal calls out the top point contributions to the Dow's rise from 25K to 50K. Goldman Sachs, about 4,000 points. Caterpillar, about 3,000 points. Apple, about 2,500 points. Microsoft, about 2,000 points. American Express, about 1,800 points. Now, I want you to picture what that means. The Dow goes from 25,000 to 50,000. That's 25,000 points of movement, and one company, Goldman, accounts for roughly 4,000 points of that rise. Not because it's the biggest company in America, not because it employs the most people, not because it has the highest market cap, but because it has a high share price and it performed. This is where perception lags reality. People see the Dow at 50,000, and they assume tech did it. And yes, tech mattered in the broader market. But in the Dow, industrials and financials have greater importance. And that is why the subtitle matters. Caterpillar and Apple also provided the push. Laggards included Salesforce and Boeing. Now, as a value investor, I'm going to ask the only question that matters. What is this index incentivizing in your brain? It's incentivizing story over structure. It's incentivizing the idea that the Dow is up means the market is up, means the economy is up, means things are good. But the Dow is a curated list of 30 stocks with a price-weighted methodology. So the reality is more specific. It's telling you, a set of high-priced shares performed well enough to pull a headline number across a psychologically important threshold. That's still real, but it's not the same as a broad-based statement about value creation. Now I want to do a decision autopsy, not of a company decision, but of an investor decision. Because every day, investors make a decision without realizing it. They let an index headline set their emotional state. They let the scoreboard set their conviction. They let 50,000 inches feel like validation. And that is a mistake. The opportunity cost is enormous, because the moment you outsource your interpretation to a headline, you stop doing the work that produces edge, understanding mechanisms. So what should you do instead? You should treat index design like you treat any set of incentives. Ask, what is being measured? How is it being measured? What is overrepresented? What is underrepresented? What does it ignore? With the Dow, the big one is simple. Market value doesn't control weight. Share price does. So a company can be smaller in market cap and still matter more inside the Dow if its share price is high. Now, the reality check. The Dow is a cultural icon. It's also a mathematical construct. When those two collide, investors tend to worship the icon and forget the construct. And the market loves nothing more than investors who don't understand the measurement, because that's how narratives get sold. So let's pull out 3 lessons, timeless lessons, from this one Wall Street Journal piece. Lesson 1. Mechanics create meaning. If you don't understand the mechanism, the meaning you assign will be wrong. Lesson 2. Attention is a scarce asset, and indexes allocate attention. The Dow's structure makes certain companies louder than others. Lesson 3. Compounding is real, but your interpretation of compounding can be distorted by the scoreboard you choose. A doubling in the Dow over 8 years feels like a universal truth. It isn't. It's a truth filtered through a specific methodology. Now I'll end with conviction, because this is the kind of conviction that keeps you rational. The Dow at 50,000 is not the story. The story is that a price-weighted index can make Goldman Sachs, at roughly $929 a share, move the headline more than companies far larger in market value. And here's the sentence I want you to remember for years. If you don't understand what an index rewards, you will confuse its number for reality, and you'll allocate capital based on an illusion. Moving to next title, Innovent Biologics, Eli Lilly Inc. development deal. $350 million upfront, and up to $8.5 billion in milestones. That's a capital allocation headline. Because when you see a number like $8.5 billion attached to milestone payments, what you're really seeing is an option structure, a structured bet on a pipeline that doesn't exist yet in public detail, a bet on a process, a bet on a machine that can reliably manufacture molecules and data. This is the Wall Street Journal on a new partnership between Innovent Biologics, a Chinese drug maker, and Eli Lilly, the U.S. pharmaceutical giant. And if you're a value investor, you should train yourself to hear the subtext in these deals. The subtext is, where is the world's marginal drug innovation being sourced? Who owns the downstream economics? And what does it cost to buy the right kind of optionality? Now, the article says, Innovent struck a partnership with Lilly to develop new treatments targeting cancer and immune system diseases globally. It marks the 7th collaboration between the two companies. 7th. That word matters, because it tells you this isn't a one-off transaction. It's a relationship, a repeated game. And repeated games create compounding. Innovent's shares finished the next trading session in Hong Kong up 7.4%. That's the market reacting not just to cash, but to validation that Innovent's platform is real enough for Lilly to keep coming back. Now let's get very specific about what the deal structure actually says. Under the agreement, Innovent leads development of the new drugs from conception through phase 2 clinical trials in China. Lilly gets exclusive worldwide rights to develop and commercialize the treatments outside Greater China. That division of labor is the entire modern biopharma economy in one sentence. Innovent is upstream. Innovent is the lab. Innovent is the early risk absorber. Lilly is downstream. Lilly is the global development machine. Lilly is the regulatory war chest. Lilly is the commercialization distribution system. And the boundary line is Greater China. Now the money. Innovent gets $350 million up front. Then it's eligible for milestone payments of up to around $8.5 billion, and it gets tiered royalties on sales of each product marketed by Lilly. Upfront cash, milestones, royalties. That is the three-part engine of these partnerships. Cash to fund the machine now, milestones as a ladder that pays out when the machine produces real outputs, and royalties as the long tail, the compounding stream, if and only if products actually reach the market and sell. Now, here's a subtle but extremely important detail. Unlike previous agreements between the two, this partnership involves both companies jointly developing new drugs rather than Lilly acquiring rights to an existing Innovent treatment. That one line tells you the relationship is getting deeper. It's moving from "we'll buy what you already made" to "we'll build together." That changes incentives, it changes governance, it changes how knowledge transfers, and it changes how each side thinks about the long term. Innovent itself says the collaboration moves beyond licensing agreements to create an end-to-end innovation ecosystem. Ecosystem is a word that gets overused, but in this context it's precise. They're describing a pipeline that begins with ideas and ends with global commercialization, where each party specializes and the handoff is designed, not improvised. Now Jefferies' head of Asia Healthcare Research, Kui Tsui, calls the deal a positive surprise to the market. But Kui adds something that's almost more important than the surprise. The drug assets and details are yet to be decided, so this is more like a framework deal demonstrating long-term partnership. Framework deal that is the language of trust and repeatability. It's what you do when you want to lock in access to a machine rather than buy a single output. It's like a manufacturer signing a long-term supply agreement for critical components, not because you know the exact SKU mix 5 years out, but because you know the supplier is strategic. Now zoom out to the broader pattern the journal points to. This collaboration is the latest in a long line of licensing deals between Chinese pharmaceutical companies and global biopharma giants in recent years. Western drug makers are increasingly seeking access to China's expanding pipeline of cutting-edge therapies and tapping its vast, cost-efficient R&D ecosystem. That phrasing, cost-efficient R&D ecosystem, is not a compliment, it's a competitive fact. It implies unit economics. It implies speed. It implies scale of experimentation. And if you've ever studied how great businesses are built, you know the best businesses don't just do one thing well, they build systems that learn faster than their competitors. R&D is a learning system. Now, Nomura's China healthcare analyst Jialin Zhang says this deal is another testament to Innovent's R&D platform. And Zhang adds that partnering with Lilly improves the clinical and commercial prospects for Innovent's new drugs outside China. That is the division of comparative advantage again. Innovent can generate candidates and early data. Lilly can translate that into global approvals and global sales. And then there's a geopolitical observation tucked into the piece that matters for anyone thinking long-term. Zhang says Lilly's continued collaboration with Chinese companies suggests a decoupling between the US and China on life sciences is unlikely to happen in the near term. That is a signal, not because it guarantees the future, but because it tells you what incentives are currently stronger than politics. The incentive is, the best pipeline wins, and big companies will pay to access it. Now, let's talk about the visual that the listener will also see on screen. On screen, there's a photo from Reuters, an event on abdominal obesity organized by Innovent Biologics, Alibaba Health, and Tmall Juhasuan in Shanghai last year. That image is not about this exact deal. It's about positioning. It's telling you Innovent is not just a lab company. It's embedded in a broader health, commerce, and distribution ecosystem in China, where pharma, platforms, and consumer channels touch. And to a value investor, that hints at something. Companies that can integrate science with distribution, directly or through partners, tend to compound more reliably than companies that only have science. Now, I want to do the capital allocation autopsy the way an operator would. What was expected? Innovent expects to monetize its R&D platform by pushing programs through Phase 2 in China, then handing off global rights outside Greater China to Lilly. Lilly expects to buy a pipeline of future products earlier, cheaper, and with a partner that can move fast inside China. What actually happened, in the immediate sense? Innovent gets $350 million now. Innovent stock pops, and the market sees the relationship deepen. Seventh collaboration, now joint development. What's the opportunity cost? For Innovent, giving away global rights outside Greater China means you cap your upside, because the biggest commercial profits often happen in the US and other large markets. But you also reduce the capital burden and the execution risk of running global trials and building global commercialization. For Lilly, the opportunity cost is dependency. Dependency on an external innovation pipeline and on cross-border collaboration. But the payoff is optionality. $8.5 billion in milestones is a maximum. It is not promised. It is a way to pay for success when success appears. That's smart capital allocation. You don't pay the full price up front for uncertainty. You structure payments so the risk and reward are staged. Now, the uncomfortable truth. In biopharma, the public loves binary stories. Miracle drug, failed trial, but the compounding actually happens in the platform, in the processes that repeatedly generate shots on goal. And this journal piece is basically telling you that Lilly is buying exposure to Innovent's shot-on-goal engine. Not once, 7 times. And moving deeper, so here are the 3 lessons I take from this, and I want them to be timeless. Lesson 1. The best businesses sell optionality, not certainty. Milestone structures are the language of optionality. Lesson 2. Specialization compounds. Innovent specializes in early discovery and Phase 2 development in China. Lilly specializes in global development and commercialization outside Greater China. Each side does what it does best, and the interface becomes the product. Lesson 3. Ecosystems beat products. Innovent is describing an end-to-end innovation ecosystem. That's the long game, because ecosystems create switching costs, trust, and repetition. Now I'll end with the core question the article raises for investors. What's really being built here? It's not one drug. It's a cross-border production line for innovation. And here's the sentence I want you to remember for years. In modern biopharma, the compounding isn't in a molecule, it's in the machine that can keep creating molecules, and the partner who can sell them worldwide. Moving to next title, Kura Sushi reels in diners as prices rise. Kura Sushi raised prices more aggressively than it usually does, and traffic improved. That's the kind of sentence that stops me, because it violates the lazy rule most people carry around in their head. The lazy rule is, higher prices equal fewer customers. But great operators don't live by lazy rules. They live by measurement. They live by segmentation. They live by the one thing that matters in consumer businesses: perceived value. This is a Wall Street Journal story about Kura Sushi USA, the revolving sushi bar chain. And the whole article is really about one thing: how you defend margins in an inflationary world without breaking demand. Not by guessing, not by across-the-board hikes, but by going location by location and item by item, like a craftsman, not like a bureaucrat. Now, why does this moment matter? Because the restaurant business is the purest classroom for incentives. You have a product that's consumed immediately. You have competition everywhere. You have customers who can switch instantly. You have input costs that can surge: fish, labor, rent, tariffs. And you have almost no room to hide. So when a chain finds a way to lift pricing and still improve traffic, that's not a gimmick. That's a signal. It's a signal that they understand their customer better than their customer understands themselves. Now, let's name the central figure in the piece: Jeff Utz, Kura Sushi's Chief Financial Officer. And I want to emphasize something. A CFO in a restaurant chain is not just a scorekeeper. A good CFO is a system designer, a capital allocator, a person who decides how much pain the business can absorb and where the business can push. In this story, Utz is the person describing a decision that could have gone wrong. He says anytime you take a menu price increase, there's going to be some degradation to your mix. Some people will order less. That's the default expectation. But he says this menu price increase was taken very well. So what did they do differently? They used feedback. They used a surgical approach. The journal says Kura lifted prices after receiving survey feedback from diners on Kura Sushi's value compared with competitors. Executives zeroed in on the restaurants with the highest scores. Think about that. They didn't start with the weakest stores. They started with the strongest perceived value stores. Then they combed through menus item by item to determine which ones could withstand a price increase. And the result was a 3.5% rise on November 1st. 3.5%. That's higher than their typical 1% or 2% lift. So it's not a token raise, it's a deliberate raise. Now let's frame the environment, because context is the pressure that forces evolution. Americans are exasperated with paying more for food, both in grocery aisles and when eating out. The journal cites Circana. Restaurant prices on average were up 3.3% in the last 3 months of 2025 compared with a year earlier, and up nearly 30% from the end of 2020. Nearly 30%. That's the backdrop. That's why pricing power has become the most overused phrase in investing. But the real question is, can you raise prices while keeping customers happy? And if you can, what is the mechanism? Kura has felt inflation before, with consumers pulling back on restaurant spending. So this time, they're looking at their own cost pressures. Tariffs on fish and other menu items. Tariffs on the popular toys that come with Kura sushi meals. And they need to offset higher costs. So the inflection point is this. The company moves from routine pricing to precision pricing. Utz calls it more surgical than usual. And the tool that makes it possible is a feedback loop built into the restaurants. Tablets around the restaurants let diners share feedback on food quality and cleanliness at that location. Then, last summer, they add an additional survey question, perception of value tied to the meal. This is incredibly important, because price is not a number. Price is a story in the customer's mind, and the story depends on location experience, food quality, cleanliness, consistency, the ritual. So they measure the story, then they adjust the number. Now, the actual pricing implementation. With that feedback, executives determined which menu items to increase and which to leave alone. Side dishes like gyoza and ramen offerings were mostly untouched. And Utz says the 3.5% lift is a blended figure across all the increases. So they didn't just crank everything, they chose the items where the customer would tolerate it, and they left some things alone, likely as anchors, value anchors that preserve the feeling that this place is still reasonable. Utz assumed diners would pull back. Instead, he says their mix improved and traffic improved. Now, let's talk numbers like investors. Sales for the 3 months ended November 30th were $73.5 million. That's up nearly 14% from a year earlier. The company posted a loss of around $3 million for the period. So we're not looking at a mature fat margin machine here. We're looking at a growth-oriented business that is still fighting for profitability. And that's exactly why this matters. Small pricing improvements, if they stick, can change the long-term earnings power. The journal says the sales improvements continued into December and January, even with the price lifts, and traffic improved from previous months, according to the CFO. Now, here's where it gets interesting, and where you have to be honest with the data. Same-store sales were down 2.5% for the period ended in November. Yet the article says positive momentum that started in the last month of the quarter continued into December and January. So you have a mixed picture. Down comps in the quarter, but improving trend at the end of the quarter and into the next months. That's not unusual. It's what happens when a new policy rolls through stores gradually and behavior shifts with a lag. Now the question, why do customers still come? The journal gives you 2 big reasons. First, value relative to other sushi. Jeremy Hamblin, an analyst at Craig-Hallum, says Kura's menu is still a value compared with other sushi spots. He gives a simple comparator. 2 pieces of nigiri, raw fish with rice, tend to cost just under $4 at Kura, and can easily be double that at other restaurants. So even after the price increase, the relative value is intact. That's the key phrase. Relative value. Consumers don't buy in absolute terms. They buy relative to alternatives. Second, the toys. This is where Kura becomes more than food. It becomes a game, a reward loop. Customers get small prizes like a badge or figurine after selecting a certain number of dishes. 15 plates for the first reward. 20, 5 plates for the second. And there are limited giveaways when a dining party hits a certain dollar threshold. The toys tend to be collaborations with popular brands like Nintendo's Kirby and the series One Piece. This is not a sideshow. This is part of the product. It's a behavioral design choice that increases engagement, plate count, and repeat visits. And Hamblin says diners love them. The article notes that last year the company did away with the prizes for roughly 5 months, and Hamblin says that contributed to softer sales. So the toy is not a trinket. It's demand generation. It's a marketing channel that lives inside the meal. Now, let's do the capital allocation autopsy. What was expected? They expected a bigger than usual price increase, 3.5% instead of 1% to 2%, to hurt willingness to dine. They expected degradation in mix. They expected at least some demand softness. What actually happened? Traffic improved, mix improved. Sales rose nearly 14% year over year to $73.5 million for the quarter. Momentum continued after the quarter. What are the hidden trade-offs? One trade-off is reputational. If you raise prices too hard in a moment when customers are already angry about inflation, you can permanently damage trust. Another is competitive signaling. If you show you can raise prices, competitors respond. And a third is internal discipline. Once you discover surgical pricing, you are committing to ongoing measurement, ongoing item-level thinking, ongoing store-level execution. That's not free. It requires systems, data hygiene, and operational excellence. Now, let's talk about the on-screen visual. On-screen, the viewer sees a photo of a Kura sushi restaurant interior. They see the revolving belt, they see customers. They see the physical system that makes Kura different. That belt is not decoration. It is throughput. It is entertainment. It is the mechanism that turns a meal into a ritual, and the toys turn that ritual into a reward loop. This is what most people miss. Kura isn't just selling sushi. It's selling a structured experience where price is only one variable among many: speed, novelty, gamification, and relative value. Now, the reality check. The company still posted a loss of around $3 million in the quarter. Same-store sales were down 2.5% for the period. So don't romanticize it. This is a business still proving out its unit economics in a brutal consumer environment. But as a value investor, I don't need perfection. I need evidence of learning. Evidence of a system that adapts, evidence of managers who understand incentives. And this is exactly that. So here are 3 lessons. Lesson 1. Pricing power is not a brand slogan. It's a process. It's measurement plus segmentation plus disciplined execution. Lesson 2. Perceived value is the only moat in restaurants. Kura measured value perception directly, then used it to decide where and what to raise. Lesson 3. Compounding often comes from small, repeatable operational wins. A blended 3.5% lift that customers accept, repeated over time, can matter more than one big strategic swing. And I'll end with conviction. Kura Sushi raised prices more aggressively than usual because its costs were rising and tariffs were biting. It didn't guess. It listened store by store, item by item. And the customers didn't run. They came in more. Here's the sentence to remember for years. In a consumer business, the strongest pricing power doesn't come from charging more. It comes from knowing exactly where value lives in the customer's mind and lifting price only there. Moving to next title, Big Business is souring on South Africa. There's a specific moment when an economy stops being cheap and starts being uninvestable. Not because the people change, not because the resources disappear, but because the operating environment becomes so unreliable that even patient capital can't do the math anymore. The Wall Street Journal calls it out plainly. Big business is souring on South Africa. And when I read this, I don't hear a political story first. I hear an incentive story. I hear a capital allocation story. I hear a compounding story. Because the most destructive thing in an economy isn't one bad year. It's the slow accumulation of friction, the slow accumulation of risk, the slow accumulation of we can't rely on the basics. And once that mindset takes hold, it spreads. Quietly at first. Then, all at once, the journal frames it as a corporate exodus from what was supposed to be Africa's breakout economy, propelled by a toxic cocktail: corruption, lawlessness, and poor infrastructure. Foreign investors, from Shell to British American Tobacco, are downsizing. And the piece suggests it could be a watershed moment, because the government's ability to deliver basic services has become so limited that private firms have taken over many basic civic functions. That line is the hinge, because when private companies start doing civic functions, you're no longer debating policy, you're debating state capacity, and state capacity is the base layer for compounding. Without it, every business becomes a security company. Every supply chain becomes a gamble. Every long-term plan becomes a short-term workaround. Now, let's get into the specific forces the article names, because this is where the truth lives. South Africa, Africa's biggest and most developed economy, has long been plagued by logistical problems, failing infrastructure, and rising electricity costs. Firms put up with it for access to mineral wealth and a growing consumer market. But now the reputation damage is stacking. A catalog of high-profile corruption scandals, often linked to laws intended to right the racial wrongs of apartheid, has eroded investor confidence and exacerbated core problems, including day-long water and power outages. And legislation designed to improve the lot of the black majority has also deterred investment. Now, I want to be careful here, because as investors, we don't get to moralize our way into returns. We have to understand trade-offs. The journal gives you a crisp example. Elon Musk's SpaceX was in talks about launching Starlink in South Africa, which could have boosted fortunes in economic backwaters. But Musk is demanding an exemption from a rule requiring foreign companies to give up 30% of local operations to black South Africans. Whether you agree with that rule or not, the investment implication is obvious. Rules change who shows up. Rules change what capital is willing to do. Rules change how long capital is willing to stay. Now, here's the number in the piece that should make any operator go quiet. The World Bank estimates crime costs South Africa's economy at least 10% of GDP annually. At least 10%. Think about that as a permanent tax, not a one-time shock, a permanent drag. Stolen property, extra costs of security and insurance, missed economic opportunities. That is compounding in reverse. That is an economy eating its seed. Some capital brings long-term reinvestment. Some capital brings short-term extraction. Some capital brings deep local supply chains. Some capital is just shifting an asset from one owner to another. Now let's do the decision autopsy, company by company, because this is where incentives become visible. Rolex. The journal says Rolex closed its South African affiliate office in 2024, citing the evolution of local markets. And then it tells you about criminals dubbed the Rolex Gang, terrorizing wealthy Johannesburg residents by robbing them of luxury watches at gunpoint, often shooting first and grabbing the watch after. Rolex won't say whether that influenced the decision. It says it's maintaining an after-sales service center. That's a pattern. Not a full retreat, a reduction of presence. Keep the revenue stream that's lower risk. Cut the exposure that's high risk. Now, Shell. Shell, along with BP, sold the refinery they jointly owned to South Africa's state-owned Central Energy Fund in 2,200 for 1 South African rand, about 6 US cents. 6 cents. That's not a sale in the way people normally think about it. That's a balance sheet cleanse. That's a decision to remove something from the books because the strategic cost of keeping it is higher than any possible proceeds. In that same year, Shell says it would sell its gas stations in the country, but has yet to find a buyer. Shell's spokesman says the company isn't leaving South Africa and continues to have various interests in exploration. But then the CFO's quote shows you the operator logic. It's less about proceeds and more about taking things that don't fit strategy off the books. That sentence is the language of constrained optimization. When the environment gets harder, the portfolio gets tighter. Now, British American Tobacco. This is one of the clearest examples of incentives turning an entire market upside down. BAT announces it's closing its last cigarette manufacturing facility in South Africa by the end of this year due to illicit trade in cigarettes that has wiped out around 75% of the local legal market for tobacco. 75% of the legal market gone. That's not competition. That's institutional failure. BAT intends to shift to an import model. Its facility, first opened in 1975, currently operates at just 35% capacity due to exponential growth of illicit trade triggered by a ban on cigarette sales during the pandemic. BAT's executive Johnny Moloto says they held on as long as they could, hoping government pronouncements would come to fruition, but they've reached the tipping point, and he adds something critical. They would reinvest in local production should government bring illicit trade under control. That's not ideology. That's conditional capital. That's fix the rules and the capital returns. The journal notes the courts later declared the ban unconstitutional, but the legitimate market never recovered. That's another compounding lesson. Temporary measures can create permanent black markets. Once habits form, they don't just vanish because the rule changed back. Now the banks. BNP Paribas closed its corporate and investment bank in South Africa in 2024, amid a broader pullback from the continent by European banks. HSBC said it would transfer its South African business to local banks and exit. This matters because when sophisticated financial intermediaries reduce exposure, it changes the funding environment for everyone else. It raises the cost of capital. It reduces liquidity. It makes long-duration projects harder to finance. Now, the article turns the knife a bit deeper. Some multinationals didn't just suffer the environment, they became part of the corruption story. Bain shut down its South African consulting business after an inquiry into former President Jacob Zuma found the company colluded to weaken the tax agency. Bain was banned from doing business with the South African government in 2022 after the National Treasury accused it of corrupt and fraudulent practices. The inquiry heard testimony over almost 3 years about alleged corruption involving contracts for favors. And then comes the brutal line. There have been no convictions related to the corruption allegations, which analysts say is evidence of further government failure. No convictions. That's the enforcement vacuum. That's the signal to every operator watching. Rules exist, but consequences may not. And when that's true, the honest players leave or shrink, and the dishonest players expand. That is how reputations collapse. Now, I want to bring in a company that complicates the everyone is leaving narrative. Anglo-American. Anglo is divesting. It's working to divest its majority stake in De Beers via IPO or sale. It spun off and sold its remaining stake in Anglo-American Platinum, now called Valterra Platinum, but it retains its majority in Kumba iron ore, plus manganese and a wine farm outside Cape Town. And a spokesman says they still see South Africa as their hub for investment into the region, and they're proud of contributions toward national priorities: energy, logistics, crime and corruption, education. This is a different posture, not blind optimism, not full exit, a selective asset-by-asset commitment. That's what rational capital does in a mixed environment. It keeps the best assets, sells the ones that require stable institutions to work, and tries to build resilience around the rest. Now let's bring the visuals into the listener's mind, because the viewer will see them. On screen, the viewer sees a photo tied to Shell's gas stations, an image that represents a tangible footprint, physical presence, real assets, the kind of assets you can't just move if the environment deteriorates. And then the viewer sees the data point. Chery agreed to buy Nissan's plant in Pretoria. A number sits next to that. 2. A small marker in the layout, but it's a reminder that capital flows don't stop, they change direction. Different players, different time horizons, different tolerance for risk. Now, here's the reality check, and it's uncomfortable. South Africa has mineral wealth and a consumer market. And yet, the World Bank estimates crime costs at least 10% of GDP. Illicit trade can wipe out 3/4 of a legal market. A refinery can be sold for the equivalent of 6 cents. That is not a valuation story. That is an operability story. And for value investors, operability comes before valuation, because a cheap asset in an unworkable system is not cheap. It's a trap. So what are the lessons? Lesson 1. State capacity is an invisible balance sheet. When it deteriorates, every company's costs rise. Security, insurance, logistics, redundancy. Lesson 2. Well-intended rules can have unintended compounding consequences. The tobacco ban helps create an illicit market that persists even after courts reverse the policy. Lesson 3. In unstable environments, the winning capital allocators optimize for optionality. They shrink fixed exposure. They move from local production to imports. They sell assets for symbolic amounts just to remove risk. They stay only where the asset quality is so high it justifies building defenses around it. Now I'll end with the core question the article forces you to answer. Why is big business souring? Because the long-term contract between capital and the state is breaking down. And the final sentence I want you to remember is this. When the rule of law and basic services stop compounding, no mineral seam is rich enough to make the investment math work. Now towards last article, picks and shovels still rule the AI tech trade. Picks and shovels still rule. That's the title, and it's also the thesis. And I want to start with why that matters. Because everybody wants the glory trade. Everybody wants to own the next platform, the next model, the next winner-takes-most company. But the market, when it gets scared, does something very old-fashioned. It starts paying the suppliers, the sellers of critical inputs, the companies that don't need to be right about which AI product wins, they just need the industry to keep building. This is the Wall Street Journal's "Herd on the Street" take on the AI trade, and the way investors have been behaving. And the behavior is messy. The article calls it a schizophrenic mood regarding artificial intelligence. And that's accurate, because the market is doing two things at once. It's questioning whether the software companies are durable in a world where AI can generate code, and it's punishing the tech giants who are spending vast sums to enable those very tools. It's punishing both sides of the same story. And when that happens, the only safe place, the piece argues, becomes the companies on the receiving end of the spending spree. The suppliers, the picks, the shovels. Now, let me anchor us in the scoreboard the article gives. So far this year, tech has been rough. By Monday's close, the Nasdaq Composite was flat for the year. The Dow was up 4.3%, and the S&P 500 Equal Weight Index was up nearly 6%, compared with a 1.7% gain for the standard S&P 500. That equal weight detail is not trivia. It's a clue. It tells you the market is trying to nullify the outsized influence of the tech giants. 8 of them, whose combined market cap is more than a third of the S&P 500's total. In other words, investors are stepping away from concentration. They want breadth. They want normality. Now, why did this start? The article says worries about AI really picked up late last year. A flurry of mega deals by OpenAI sparked legitimate questions about how a cash-burning startup can make good on $1.4 trillion of chip and cloud computing contracts. $1.4 trillion. Let that sit in your head for a second. If you're an allocator, a number like that forces you into a different mental model. You stop thinking about product innovation. You start thinking about financing. You start thinking about counterparty risk. You start thinking about who's left holding the bag if the growth story doesn't convert into cash flow. And then there's the human element. During the first week of November, OpenAI's CFO Sarah Frier made comments at a Wall Street Journal conference that appeared to suggest the company was looking to the federal government as a backstop. The company denied that interpretation quickly. But the market doesn't need certainty to reprice risk. It needs a whiff of instability at the top of the AI heap. And the Journal says that episode was taken as another sign of instability. Many major tech stocks fell sharply that week, taking down the Nasdaq, which had hit a record the week before. And most haven't recovered. Alphabet is the exception. Among AI-exposed tech giants, it's the only one that gained ground since the Nasdaq peak on October 29, 2025. Now, here's the part that should make every value investor lean in. Investor apprehension hasn't compelled the biggest tech companies to scale back their AI bets. Google, Meta, and Amazon used their latest quarterly reports to project major increases in capital spending for the current year. Wall Street is projecting notable increases from Microsoft and Oracle too. And taken together, those 5 companies are expected to spend $715 billion this year. That's expected. Projected. Not hypothetical. And the article says that's a 60% increase from last year. $715 billion. Up 60%. This is not incremental investment. This is an arms race. This is the kind of spending that creates second-order ecosystems. Because once you start building data centers and AI infrastructure at that scale, you are not just buying servers. You are rewriting supply chains. You are rewriting power demand. You are rewriting who has pricing power in semiconductors, memory, and manufacturing equipment. Now, investors aren't thrilled. Meta was the only big tech stock to rise following its report, because investors were willing to look past the CapEx surge given accelerating growth in the core advertising business. But then, Meta's stock gave up those gains later. Google, Amazon, and Microsoft all fell since their reports. And again, the damage is uneven. Alphabet's stock fell less than 3% since its earnings announcement and is still positive for the year because strong growth in core business units offset most of the sticker shock. Microsoft is down 14% since its report. Amazon is down more than 6% since its latest report, and the Journal offers a comparison-based explanation. Google looks better because it has its own frontier AI models directly challenging OpenAI, and it has a much bigger balance of net cash to fund its AI pursuits. In other words, Same arms race, different balance sheet strain. Now I want to bring the on-screen visuals into your mind, because in this piece, the visuals are the evidence. On screen, you see a chart of year-to-date index and ETF performance. You see the PHLX Semiconductor Index. You see the Nasdaq Composite. You see a Nasdaq Internet Index. And you see a tech software sector ETF. It's a quick way of showing chips versus software and the divergence in investor appetite. Then, on screen, you see another comparison: share price and index performance since the Nasdaq peak on October 29, 2025. A lineup that includes Microsoft, Broadcom, Meta Platforms, NVIDIA, Amazon, Alphabet, and the S&P 500 Equal Weight Index. This is the market's way of saying, since the top, who held up? And then the most important visual for a capital allocator: a bar chart of capital spending per calendar year. It runs across years labeled 2022, 2023, 2024, 2026. The companies shown are Oracle, Meta, Amazon, Microsoft, and Google. And the note says Oracle's capital spending represents a year ending in November, and the 2026 amounts are projections. This is the spending engine. This is the fuel source for the picks and shovels trade. Now, what are those picks and shovels in this article? Semiconductors? Yes, but the piece gets more specific and more interesting. It says the biggest chip beneficiaries lately have been in the memory business. DRAM and NAND flash are crucial in data centers, and the key constraint is supply. There isn't enough production to satisfy AI demand and still supply memory for PCs and smartphones, so memory prices are soaring. Counterpoint Research says prices have jumped 80% to 90% so far in the first quarter. 80 to 90%. That's a violent move. And it has a simple implication. It's bad for any company that has to buy memory. It's great for the makers of memory chips and the equipment companies that supply them. And then the article gives you performance proof. SanDisk, the flash memory maker, has more than doubled in value in the past 3 months. Micron has surged more than 60%. Lam Research Tools, heavily exposed to memory, up more than 40%. This is exactly the pattern the title is pointing to. When uncertainty rises, investors stop trying to pick which AI application wins. They buy the bottlenecks. They buy the suppliers to the bottlenecks. Now, let's confront the other side: software. The journal says questions about AI's ultimate future haven't stopped investors from assuming the worst for software companies. The belief is big companies will someday use AI to make software for internal needs instead of paying hundreds of millions to Salesforce, Workday, ServiceNow. And the piece calls out that there are many problems with that assumption. Enterprise software is complex and mission-critical. Even NVIDIA's CEO Jensen Huang calls the idea of AI killing software the most illogical thing in the world. But the market doesn't always price logic. It prices fear. And after Anthropic released more powerful coding assistants and corporate task functions, product management, and the like, investors hit the sell button again. It even spread to names previously thought safe. Palantir is down more than 19% so far this year, after being up 135% last year. Cybersecurity providers like CrowdStrike, Palo Alto Networks, and Zscaler are down substantially after rallying in 2,200. Zoom is one of the few positives, and even that has an AI angle. Zoom is an investor in Anthropic, and an analyst suggested that stake could be worth $2 billion to $4 billion, pushing the stock up more than 11% after the report. So you can see how reflexive this has become. If you have AI exposure, you get a narrative bid. If you sell software that AI might threaten, you get narrative punished. If you spend CapEx to build AI, you get punished again. Now, let's do the capital allocation autopsy. What was expected? The expectation was that AI would be an accelerant, a growth machine for tech, that the platform companies would spend, yes, but investors would reward the long-term moat, that the software companies would keep selling subscriptions because enterprises don't rip out mission-critical systems overnight. What actually happened? A financing and counterparty question at the top. OpenAI and the scale of its commitments infected the whole complex. The builders got punished for spending, the sellers got punished for being potentially disrupted, and the market fled into the suppliers, especially where constraints are tight, like memory. What is the opportunity cost? If you're selling the picks and shovels, the opportunity cost is missing the upside of the eventual platform winner. But the trade-off is you don't need to predict the winner. You only need the arms race to continue. If you're buying the big tech spenders, the opportunity cost is short-term multiple compression and investor anger. But if they're building durable infrastructure that becomes a moat, the payoff could compound for a decade. If you're buying software, the opportunity cost is living through a narrative-driven drawdown, while fundamentals may remain intact. But the upside is that the market may be overpricing a disruption that is harder to implement than it appears. Now, I'll pull out 3 lessons. Lesson 1. In gold rushes, the most reliable compounding often sits one level removed from the glory. Suppliers compound when builders keep building. Lesson 2. Capital spending is a signal, but it's also a vulnerability. $715 billion projected capex, up 60%, means the ecosystem will grow, but it also means investors will demand proof of returns. Lesson 3. Markets reprice narratives faster than reality changes. Software didn't die, but its valuation can get treated as if it has no terminal value when fear takes over. Now I'll end with conviction, because the article's thesis is simple and it's right. In this phase of AI, the market doesn't want dreams. It wants invoices. It wants bottlenecks. It wants companies that get paid because the giants are spending whether or not the ultimate AI promise arrives on schedule. And here's the sentence I want you to remember. When the future is uncertain, the safest compounding often belongs to whoever sells the scarce inputs to everyone chasing the future. This is Avi. Like and subscribe. On to the next.